All right, so our phone lines are open as we kick off the third hour of the Elias Macko Show. Thanks for tuning in. And if you've got tax questions, now is the time. And call early here, because I know when we do these segments, we get bombarded with calls at the end of the segment. I want to make sure everyone gets a chance here. Already getting many great questions on the text line, 514-790-0800. It is tax season, and if you have a specific tax question you'd like to have handled, it's our pleasure to welcome Robert Raich back onto the program. He's a tax lawyer with the firm of Raich Legal, and he's been very generous with his time this morning to help our listeners out. Robert, welcome back to the show.
How you doing, Elias? I thought you'd be busy with figuring out the tariff business. I can't believe taxes take precedence.
Robert, let me tell you something. It's been all morning on the show. I need a breather. I don't want to talk about Donald Trump, at least for a bit. So thank you, by the way. I'm sure you might have to bring up Donald Trump in one answer at one point, but I'll take as much of a break as I can get.
I don't blame you. And just to let you know, I have my summer student, David Almasawi Wasserman, who, if I don't know the specific answer to a dollar question, he'll do it, and then I'll go back to it because I'm a tax lawyer. So if you're going to ask me, what is the marginal rate on somebody earning $62,000, I'll have to do 2 seconds of research. I don't know it off the top of my head, but I'll do my best.
Well, that just shows how legit you are, that you've got the team behind you to help you out as well. Okay, so I'm going to get to our text messages that we've gotten here, but I'm going to throw one at you. Okay, let me just throw one thing at you. I don't know if this frustrates you because it frustrates me.
I hope it's a lob pitch.
I think it's a lob, which is this. This is the question. Why do I even have to do taxes? I remember one year, okay? Like I got, you get these forms, right? The T3A, the T5B, like all these little forms. And I forgot to include one, probably because it was only on a website. I failed to download it. I forgot. It was a small account. I forgot. So I do my taxes. Then I get a thing from the government. They're like, oh, you forgot this. We've readjusted your taxes. And I'm like, well, hold on a second. You must have all of this documentation already. Why do I even need to do the taxes? Why can't the government just send me the bill?
You are correct for most people, because most people get either T4s or T3As or whatever, or T4As. But there's the people that have to do taxes are people that invest, for example, in the U.S., so that the U.S. information, or in Europe, does not come on the Canadian website. But for, let's say, 90% of taxpayers, you're probably right. They have all the information. They could press a button and say, this is what you owe. So I would agree with you for 90% of the people. Other people that get involved in complicated, let's assume somebody is lending somebody money, and that's somebody who's paying the interest, does not report the interest that was paid. All of that stuff that doesn't go to the government, those type of people would have to file a tax return because it's above and beyond what goes into the tax docket for you, Elias. So therefore, yes, you're right in 85% of the cases, but I would say that they should do that. But anybody that has a little bit of complication would have to add the stuff that's not included in the website.
All right, so I have this question here sent in from a listener at 514-790-0800. Harris writes this: what is the status of the Liberal capital gains tax increase?
The answer is, officially, they have said that the inclusion rate will go to 2/3 from 50% on January 1st, 2026. However, the only problem with that is the two leading candidates, Chrystia Freeland and Mark Carney, have said that if they're elected, they will scrap it. So if you want my opinion, it is not going to happen, and you don't have to worry about it because the two candidates, and I don't know what the other two candidates have said, but I doubt they'll be elected. So if Freeland and or Carney said they won't implement this, then I think it's, for all intents and purposes, dead.
Gotcha. So, but let's say you have those significant capital gains, right? What are you doing right now? You're submitting it and you're paying the lower rate? What is someone doing?
Whoa. Yeah. Are you talking about something that happened in 2024, something that happened in 2025? What do you?
For last year.
No,
okay.
Last year it's up to they've said that totally not applying the rules for 2024 or 2025.
Okay.
So it's at the old rate. So people like me who thought I was smart and wanted to lock in some old capital lock in some capital gains at the old capital gains rate, I pre-sold stock and I'm prepaying taxes. But that was because I believed the government was going to implement it.
Go through, yeah. Okay, here's a question from a listener, again off the text line. Is it still the case that one can gift $10,000 to someone and that someone does not have to declare it? What about giving other people cash gifts here?
You can give somebody $100 million and you don't have to declare it. In Canada, there is no requirement, as there is in the U.S., to report the receipt of gifts. So there is not, I don't know where this $10,000 came from, because that I've never heard of that. But in Canada, if somebody gifts something to someone, and I'm assuming it's cash, because if you gift an asset that's appreciated in value, it's as if you sold it. But let's assume just a gift of cash. There is no reporting either by the person making the gift or by the person receiving the gift. And there is no dollar limit.
There's no limit? So, like, I'm just wondering about that, right? Because let's say you got a couple, and can the spouses basically transfer each other unlimited amounts of money, avoid taxes that way? Like, I'm just trying to think about all the ways you could avoid taxes if you can gift money.
Okay, spouses is another story, because to the extent there is a gift between transactions between spouses are tax-free unless you want them to be taxable. So that's an exception. I don't want to go. But the issue on gifts between spouses is the person making the gift is taxed on the income by the recipient spouse. So let's assume in order to split, now there's a million ways to make legitimate loans and stuff, but if somebody says, my spouse has no income, therefore I would like that spouse to have some income, so the higher net worth spouse, will make a $100,000 gift to the non-income earning spouse. The income earned by that spouse will be thrown back into the income of the giftor, so it's really no advantage. Now, whether the government can find it is another story, but there are a lot of techniques such as a loan between the higher income spouse to the lower income spouse, and as long as interest is paid on that loan at something called the prescribed rate, which I believe is around 5% now, then whatever gains are realized by that lower income spouse will be taxed in that lower spouse's income tax. So there are gifts themselves, no problem. Transfers to children work, or loans to children work, because they're usually in the lower bracket. And if they realize capital gains on what's lent to them, there's no attribution back to the parent. And it's a little trickier between spouses because there is attribution back.
I have a question here from a listener that says, if I lend money to someone and they default on the loan, can I claim it on my taxes?
The answer is if the loan was made for interest, okay, so if it was a non-interest bearing loan, unless there was extenuating circumstances, probably not. If it was a interest bearing loan and there's a default and the person can't collect, and I'll come back to that in a second, then the person making the loan can usually claim a capital loss unless they're in the lending business, which probably isn't the case. But the government will say you can't claim a capital loss unless you've really tried to collect the money, meaning you've sued the person or tried to collect by seizing assets. You can't just say, I loaned somebody $100,000. I didn't get repaid. I'm taking a loss, but not follow up and try to take steps to collect on that loan.
All right, we're answering your tax-related questions. It is tax season, and if you've got a question about your taxes, you can get some advice here right now with Robert Raich. He's a tax lawyer from the firm of Raich Legal. Robert, we're going to go over to Sandy on the phone line because she has a question. Sandy, you are on the air. What's your question for Robert?
Hi, thanks. So I'd like to know if capital gains exemption for primary residence was used, and then the house was passed along in an estate, can the heir take use that primary residence exemption as well if they're living in it?
Sure. there would be 2 points in time. One, when the person passes away, then on the passing of that person and filing the terminal tax return of that person's estate, they would claim the principal residence exemption, so no taxes would be payable. And when the person who's been willed the house, let's assume a child, that person will start, will pick up the value of the house for tax purposes at the fair value on the decease of the parent, but will then be able to claim the capital principal residence exemption going forward.
Sandy, does that answer your question?
Thank you. Yes.
Okay, wonderful. That's Sandy's question right there. 514-790-0800 if you want to send me a question. Here's one from the text line from Steve. And they ask this: if you owe the CRA, the Canada Revenue Agency, but they never issue a notice of assessment or an invoice, how do you pay? Robert, what do you say to that question?
I don't know. How would you know that you owe money if you've never received an invoice? But the answer is, and unfortunately the system in its attempt to become more internet friendly has become hard to reach an individual. And when you have to call the phone lines, it's a nightmare waiting and waiting. But the answer is either write a letter saying, I know I owe X dollars or approximately X. Here's a check to cover it. Please contact me. I mean, it would be just a letter, but I'm a little surprised that somebody would know they owe money and not have either a bill or a notice of assessment. But if they know they owe money and interest rates on overdue taxes are extremely high, like 9% currently, I believe. You have to take it in your own hands and say, here, I know I owe some money. Here's an estimate with respect to such and such a year. Please contact me.
Let me ask you this question. This is from Nancy on our text line. Can a person claim the living alone allowance when his adult child is living with him, each filing their own taxes? Is that that
one I don't know, but I'm going to get it checked. Hold on, a living alone allowance. Let me come back to that. So, David, what's your answer on that one? Okay, we'll take a look.
Yeah.
So the question again is somebody is asking whether they can claim a living alone allowance when they're living with a child, both of which are filing their own tax, both of whom are filing their own tax return.
That's right.
I'll get back to you in a second on that one. Where, as I said, I don't do the filing of taxes. I do more tax planning, but I'll get back to you in a few seconds.
Okay. Well, what we'll do here, Robert, we'll go to a caller while we wait for that. Okay. And wait for David there. So here's Donna on the line. Hi, Donna.
Hi. If I leave my house to my brother, does he have to pay tax on that when the house gets sold? Because the condition is he sells the house.
Well, are you going to give it to him while you're alive?
No, once I pass away.
Okay, so in your will, you leave the house to your brother.
Yeah. Does he have to pay tax on that if he sells it? He will never live in it. He will just sell it and do what my wishes are with the remaining money of the house.
On your passing, there's no tax on the value of the house. So he inherits it on the same value that your terminal tax return shows. So if, for example, the house was worth $450,000 on your passing, there's no tax to your estate. He's deemed to acquire it for $450,000, and if he then sells it for $480,000, there would be a $30,000 gain that he would have to pay tax on.
And what about for the welcome tax? Because it's a gift to him, does he have to pay the welcome tax?
No, because it's through a will. There shouldn't be the welcome tax.
Okay, thank you very much.
Thank you, Donna, for your question there. Can I just ask you, Robert? Do you advise?
I'm going to let Dave. Okay, so hold on. I think we have an answer here for the other question. What is it?
Oh yeah, on the person claiming living alone allowance when their adult child is living with them.
They have to be alone. We're reading. You have to get if they're living alone or only with one or more minors, or one or more of your children, full-time students. No, the answer is you can't.
Okay.
So where's that? We got a website under Revenue Quebec. It says they can. What's the reference? It says age amount for a person living alone, and amount for retirement income. And the requirements are you're either living alone with a minor child or with a major child who has some sort of dependency.
Oh, gotcha. Okay, so if the adult child has a dependency,
they don't have the adult child in the example you gave.
Yeah,
filing. Assuming there's no dependency.
That's right.
They cannot claim the living alone allowance.
That's right. That would be the difference there, obviously, is if the adult child has some sort of dependency. Okay. Let me ask you here another question coming in. Once my child starts post-secondary education, can I withdraw the maximum allowable amount from their RESP each year before they incur income taxes to ensure all contributions, government grants, and investment gains are utilized efficiently?
Yes. Now, the RESP, again, yes, you can structure the payments out of the RESP and coincide it with the payment of the deductible, sometimes deductible university fees, and there's a whole sort of proper way of ensuring that you're pulling out of the RESP, because sometimes you pull out RESP to pay for the housing costs, depending if the person is not commuting. But yes, the general answer to that question is yes. By proper planning, you should be able to maximize the government portion, the earnings, and as well as what's gone in, and the whole thing should presumably be tax-free if properly structured.
We're going to head over back to the phone lines to Sharon, who is in Ilpero. Hi, Sharon.
Hi.
Hi.
I'm wondering, I'm 75, my husband's 81. He had a massive stroke last year and a massive heart attack, and we're both still working from our homes. Can I claim a caregiver exemption?
Can you claim a, sorry, I didn't hear the last part.
A caregiver exemption.
No, I don't believe that a spouse of someone in your situation can. Hold on. Wait a second. Yes, it says, boy, I'm glad I have David that can do this quickly. It says, who is eligible for the Canada caregiver amount? It says you can claim the caregiver allowance in Canada if at any time during the year you provide support to your spouse who has an impairment in physical or mental functions. So to the extent you can get a letter from a doctor or a CLSC, then the answer is yes.
Okay, excellent. Thank you so very much.
No problem.
And this answer, which took David 30 seconds to find, was he went to TurboTax, Intuitive TurboTax, so this is what I'm reading it from off the internet.
Okay.
Wonderful. Thank you very much.
Thanks, Sharon. Appreciate it. Let me scooch over Mary. Mary, you'll get the last question in here. What's your question, Mary?
Okay. My question is, when you leave money after you pass, and if it's at the tax-free savings account, is there an impediment there for direct
No, the bequest of a TFSA to anyone is not taxable, because it wasn't taxable if the person who passed away would have pulled it out while they were alive. So it's not taxable to the beneficiaries when they pull it out for the same reason.
Okay, so there's no problem as opposed to the other investments.
Yeah, RRSPs are, as you know, if somebody passes away with money in an RRSP, the full amount in the RRSP is included in income in the last tax return of the deceased person, unless they give it to the spouse. So there's usually a very hefty tax bill in connection with leftover RRSP proceeds. But at TFSA, there's no such problem.
Oh, really? I didn't know that.
Yes.
Oh, yeah, because it's a deferred tax. So they have to pay the tax if it's not used up. Okay,
right.
Thank you very much.
No problem, Mary. Thank you so much. And Robert, we're going to thank you for your time this morning. Thanks for answering all those questions. Really do appreciate it.
Well, we'll see how many of my friends are listening, because last time I was on your show, I got like so many email blasts saying, what are you doing on the radio? So I always find that humorous. So thank you for giving me the opportunity of answering the questions. My pleasure. And now we'll go back to tariffs.
Absolutely. Robert, thanks so much, and say thanks to David as well. That's Robert Raich right there, tax lawyer with the firm of Raich Legal.